My name is Amy Becker, and today we're going to talk about personal finance. It is going to be kind of a basic introduction to several aspects in the finance world, and we're also going to spend quite a bit of time on fraud because unfortunately, fraud does come along with personal finance. Where there's money, there unfortunately is fraudsters. So we will spend quite a bit of time on that as well. I worked in the banking industry for almost a decade, and almost half of that was spent in the fraud department. I also have an undergraduate degree with an emphasis on personal financial planning, and I worked in a financial planning firm for a couple of years as well. I have a master's in business from Emporia State, and I just finished my master's in library science this last December, so that's been exciting. That's where I'm hoping that my career will go, as I love to share information with people. So I think we're ready to get started. If you have questions, please just enter them in the chat and we'll try and get them answered as we can. But I think we're ready to get started. So thank you all for joining me. So today's agenda, we are going to talk about the 6 different personal financial areas. We're also going to spend a little bit of time on emotional finance, real life fraud examples. So you get to hear some of my own experiences, as well as some fraud red flags. So we can hopefully get everyone else prevented from falling victim to a scam. So if we look at the different finance areas, cash flow is number one. Insurance is the next one. And these are in no particular order, just kind of how they flow with your life. And then we have investments, taxes, retirement, and estate planning. So you can see this kind of encompasses your whole life and the different aspects that are going to be touched by your personal finance as you go through these areas and you go through the stages of your life. So we'll start with cash flow, which I would say affects everyone and is probably the easiest one that you can make sudden changes to. So the first thing we're going to look at is net worth, and that's just a good snapshot of what your current worth is. It's simply your assets minus liabilities. And it's okay to have a negative net worth, especially as you're trying to build wealth. We'll do a really simple example. Let's say you have a $10,000 car, and that's the only asset that you actually own, but you still owe $5,000 on a loan. So it looks like your net worth would be a negative $5,000 right now because you still owe that. I'm sorry, you would be a positive $5,000 because if you sold the car, you'd be able to get $10,000 for it, pay off the $5,000, and then you would have a $5,000 net worth. So again, that's a very simple equation for it, but it just shows you an example. It's just you're adding all your assets and then you're subtracting what you would owe. So any debts that you have. And like I said, it can change over time. And as you get older, that wealth should grow as you're able to pay down some of those debts. I know when I left college, I probably had a negative, $45,000 in student loan debt and no real assets to my name. But I'm happy to say that now, 20 years later, it's turned around and I definitely have more assets than liabilities. So it just kind of depends on your stage in life and what's going on. So the next thing, everyone's favorite topic, is budget. Budget is an essential part of financial planning. There's really no way around it. If you don't know what you have coming in and what you have going out, there's really not a lot you can do to plan and look to the future because you really have no idea what's going on. Yes, budgets are tedious. They're boring. For most people, not a lot of fun. I will say I always enjoyed budgeting. I just thought it was so much fun to see where my money went and how much I could save each month. But alas, not that many people share that love that I have. My husband is one of the more common people who hates budgeting, and you would think I was pulling teeth with him trying to get him to talk about one. So he leaves it to me and we move on. So again, budgeting, you're going to look at what usually it's on a monthly basis because your expenses tend to be monthly and it's easier to break that down, but you can also look at it over an annual basis as well, just to kind of see where you are. So with your budget, you're going to see what your income is each month. And if your income fluctuates, it's best to try and get kind of an average. That way in the months you make more, maybe you aren't spending as much, so you can save that money back for the months you make less. So it's good to find kind of an average spending in those cases so you know what each month looks like. So once you get your income figured out, you're going to look at your monthly expenses. So all your bills and your expenses that occur monthly. So we're going to have electric, cable, more than likely rent, mortgage, car payment, potentially, things like that. You're going to add them all up. And then you'll take your income, subtract those monthly expenses that you found, and then you're going to get your discretionary income. So your discretionary income is kind of your fun money, so to speak, except it seems like there's never enough of it. So a discretionary income, that's going to be like your groceries, Netflix, all those items that you feel you can't live without, but when it comes down to it, you may be able to. Discretionary income, this is probably the easiest thing to look at and see what you can cut back on. So even tracking your spending, not making any changes, do it for a week or a month, you can see where you're at and you can see where your spending is. So maybe you don't realize, oh my gosh, I'm eating out lunch 5 times a week and I'm spending $80. I had no idea. Or, the Starbucks runs that we're all addicted to, myself included. But anyways, that $5 coffee adds up. And so maybe those are just quick ways you can cut back some of the discretionary spending. But it helps if you look at it and write it out, and then you can see where you're at and what you actually have. Discretionary income is also a good way to look at your phone bill or your cable bill. Maybe it's time to just cut the cable completely and see if you can get by with Netflix or Hulu. I mean, there's so many options nowadays. That could be something. Or your phone bill. Have you checked it in a while? There may be cheaper options right now. So there's little things you can look at to see if your discretionary income can improve. But again, you got to do the dirty work of tracking those expenses to make sure you know where you're at. And so then another part of budgeting is debt. That's going to be car payments, student loan payments, and so forth. That is money that you owe. They're obligations that you owe. Credit card debt is a big one, and one if you can avoid, please do. The high interest rates on a credit card cause it to be, you want to use it in an emergency only situation, or if you do feel comfortable where you can pay it off each month, that does help you build credit over the long run, but it can be a slippery slope. So I recommend not using a credit card unless you're very comfortable with your spending and know you can keep it under control. Otherwise, it's really easy to max out those cards really quick, and then suddenly you don't realize that debt's added up. It's so easy to swipe a card. So it's important to be cognizant of that, as well as if it does get out of hand, to make sure you're aware of that and try and work in ways to pay it down faster. So after debt, then comes the really good part, which is savings. So hopefully there's money left over each month that you can put into a savings account, and then you can build that savings so you have a nice cushion should something come up. You got your emergency fund and so forth. Also with savings, I think it's good to look at long-term and short-term goals. So long-term, maybe there's a wedding in the future and you know that that's going to be a couple years down the line, but that can be a big expense that you'd want to start saving for now. Short-term goals, of course, we're in a pandemic right now, so spring break might not be happening. However, that could be something that could be a short-term goal. You want to go to the beach for spring break, and you better start saving, 6 months or a year out to make sure you have enough for it. I think having these financial goals really help prioritize where you want to spend your money. So if you know what you want to spend your money on, you can help save now for those goals in the future. And I think it kind of gives it more meaning, so you're not just dropping money into a bucket. I also think it's important. You got to think of present you and future you. And present you need to enjoy your life now, but not so much that future you suffers, right? Because your future you, hopefully you live a nice long life and you get to retire, and there may be things down the road you want. So it's good to kind of prioritize that. At the same time, I'm not saying you need to cut out everything fun from your life, because present you needs to enjoy yourself as well. So it's just a matter of making sure present you doesn't take away from future you. And then of course we have past you who accumulated all that debt you have to pay off, right? So you got to think of that as well. And I'm just kidding about past you, because obviously the debt, most of it was thought through and needed to happen, but you are paying for it now. So it's important to prioritize all of that. All right, so after we get through cash flow, we move on to insurance. which I always call a necessary evil. It's an expense everyone hates to pay for, but you've got to have it. It's there to protect what you have. So if something catastrophic happens, it's there. So while it sometimes feel like this money is going towards nothing, should something happen, you'll be so glad you have it. So probably the most common insurance, you got your car insurance, which of course it's illegal to drive a car without minimum amounts of coverage. So I would hope everyone on here has car insurance. Again, if you're in an accident, that coverage is invaluable because those amounts can skyrocket very quickly between hospital bills, car repairs, and so forth. So having that car insurance, hope you never need it, but know that you're paying for it should you need it. And then we have homeowners or renters insurance. So of course, homeowners is going to tie into your mortgage and is going to be something that if you have a mortgage, you're required to have, and it's all part of the payment. So that makes it fairly easy. Your realtor would help you and your insurance agent, making sure you have the right coverage. And then there's renters insurance, which is something I think some people overlook, but with your apartment, while the building's covered by your renter, or I'm sorry, the rental, whoever you're renting from, the stuff inside is not, and that's where renter's insurance is coming in. It's going to cover anything. So like a fire destroys all your belongings or your house gets robbed, something like that, your renter's insurance is going to kick in and help you cover for any losses that would happen. So it tends to be a fairly inexpensive item, but it's something that if you're renting, you should definitely have. And then there's life insurance. There's two types of life insurance we're going to discuss very briefly, and that's term versus whole life. So life insurance is really an income protection. If you're married with kids, and let's say your wife's a breadwinner, the husband stays at home, we would want to make sure there's life insurance on the wife. So if something happens to her, that income is protected. Term life is going to give you that protection for so many years. So you can buy a term life insurance policy for around 20 years, we'll say, which is nice. Let's say that your wife is 40, she plans to retire at 60, you get a term life policy, you pay for those 20 years, you got coverage. Hopefully she makes it to 60 and the term life goes away. Because she's retired, you don't need that protection anymore. But it is a more affordable way than whole life. Whole life is going to be an option that gives you a cash value. So while you're also getting the life insurance coverage, should something happen to, in our case, our wife, you still have that coverage. But in this case, you can cash out the policy for the cash value that it's built. So basically it's saying that the money, the premiums you're paying, we're going to save some of that back because of the insurance, you're not using it. So it's building this cash value for you. So it's going to be a little more expensive, but it just really depends on what you're looking for and what you're trying to achieve with that coverage. And I'm not going to discuss medical right now, but I will say a quick word about disability insurance, especially for younger people. The likelihood of you becoming disabled versus actually passing away is much higher. So if you can get disability insurance, it's almost as necessary as anything else because the chances of a disability happening is pretty high. There is short-term and long-term disability. So short-term is going to cover the amount of time before long-term kicks in. And I believe it's 6 weeks, and then you get that long-term insurance. Disability insurance, which is going to give you income back. I think it's 66%, but it depends on the policy. But I would definitely encourage everyone to look into that option. If it's a benefit, you should absolutely be paying for it because, like I said, the risk is fairly high that a disability would happen over passing away. Okay, and now we're going to break away into investments. And I do have a nice joke for you. How do you make 1 million in the stock market? Start with 2 million. For some people, that may seem like, oh my gosh, yes, that's how it works. The stock market, I don't want to touch the stock market. I think that's actually a good viewpoint. The stock market's really volatile and it's really risky. Whoops. And for me with investments, I worked at a firm, we were a fee-based firm, which means that we charged based on the amount of assets you had with us. So if you had $100,000, we would take like 2%. So we would get a $2,000 fee on an annual basis. Very simple example in this case. So with fee-based, if your investments do better, then the advisor does better, which is a great way to go. Right? Everybody wins. Commission, while there's a place for it, it is less common to find commission-based reps nowadays because they've changed some regulations. But with commission, the advisor gets money every time they buy and sell certain items. So there can be incentive for someone to buy and sell more often on a commission basis. Not that the advisor would, but there is a incentive there, and it's something to think about with what you want. So with investing, the best thing you can do is diversify. So let's look at the stock market. Say I want to buy a stock, and I think I want to buy Apple stock, right? We all love Apple. Apple's going to do fantastic. So if I buy Apple and then next year we find out that Apple CEO dies and that they have a huge lawsuit coming and Apple just can't take it and they tank. So then all this money I put into this Apple stock is gone because I put it all in one basket. It's gone. So with diversification, it's looking at, well, if we buy a lot of stuff, chances of one of those being bad it's probably likely, but all of them being bad is probably not likely. So diversification, it's buying a lot of stuff so you don't have all your eggs in one basket, so to speak. It tends to be broken down into stocks, bonds, and real estate as a different areas of investment. But again, it's kind of going to depend on the investment advising firm you go to. But those would be the ones I recommend. And then across those, you can have a different risk level. Your advisor should be asking you about your risk level. So are you one who, thinking about your money being invested, are you going to be up all night worrying about it? If you lose $1, are you going to be upset? Are you going to be checking it a lot? Or are you the type who's like, whatever, it's in there, keep me posted every couple of years, I'm good. Once that level is determined, then allocations can be set up. Bonds tend to be less risky. So if you're risk adverse, you would probably have a higher portfolio in bonds. I took my mom to an advisor, and with her risk level and her being in her 60s, she had a much higher portfolio with bonds in it versus me. I would probably put a lot of stocks in mine because I have more time and I can handle the risk. So it really just depends on the person and your life stage. So the biggest thing with investment is keeping ahead of inflation. Inflation on average raises about 2 to 3% every year. So with investing, the hope is you'd be able to get more than that. On average, the S&P has kept about a 7% rate of return. So compared to that 2 or 3, it's going to stay ahead. Of course, that's based off of history. We don't know what's going to happen in the future, but it is a good rule of thumb that by investing, you should be able to beat inflation, which is the idea. Again, investing is long-term. The longer you can wait it out, the better, because I mean, gosh, we can look at this last year. How many times did you hear the stock market went down or the stock market went up, or oh my goodness, what was going on with it? It's best to just look at the long term. In 10 years, are we going to think about this 1 year? Probably not as much. It'll even out as we go. So we got to make sure we're not caught in the moment and that this really is a long-term approach. And again, there's no magic trick. Like I said with the Apple stock, I mean, you can get lucky and pick a good company. But my husband and I were talking the other day about how Amazon was told back in the early 90s that they probably weren't going to make it and they should sell to Barnes and Noble. I think that has been proven wrong many times over with Amazon. So again, you really don't know what's going to happen with all these businesses. All right. The next thing we're going to look at is taxes. And boy, this is the right time of year for that, right? I'm sure we've all heard the saying, the only sure things in life, death and taxes. And unfortunately, that's true. So with taxes, I'm not a tax professional because frankly, this system is so convoluted. Every time I try and think I have it sorted out, it seems like they've changed something. So we're just going to go over a few definitions that I found very helpful in trying to understand, at least doing my own income taxes. So the first one is gross income. Gross income is going to be the amount of money you would make before everyone gets their hands on it. So if you make $10 an hour, you work 40 hours a week, that's $400. That's your gross income. Of course, we know Social Security and all that other good stuff comes off of that, but that is what you would make in a perfect world without taxes. From the gross income, then we have deductions. And deductions are going to be items that you can use to actually reduce that gross income. One of the more common ones is going to be traditional Roth IRA deduction. Since you don't pay taxes on that deduction, you can take it off from the gross income. Student loan interest is another one. So for those of you paying on student loans or have that to look forward to in the future, the interest up to $2,500 can be deducted. And then from there, after we take off our deductions, we have our AGI. So that's our adjusted gross income. And that's the amount that your taxes actually calculated from. So the lower that amount can be, the better for your taxes. And then we come to, so once we get your tax liability, what you actually owe in taxes, if anything, come the credits. And the credits are the fun part. Credits can be either non-refundable or refundable. You want the refundable ones, and I'll explain why. With credits, there are some for education. And of course, I think we've all heard of the child care credit. If it's non-refundable, then what that credit will do is take your tax amount down to zero. So if you owe $700 in taxes, the credit's $1,000. You take that $1,000, but it goes down to zero. That's it. You just get to take the $700 that you owe. Now the refundable credits, let's say you have $1,000 credit, you owe $700, they're going to give you that $300 back, which is how the child care credit works. And it's how some people end up with these large refunds because they get those credits, which is great. And that's, the more kids you have, the more credits you have. But again, the more kids you have, the more expensive it is. So it evens out, I'm sure. And then down at the bottom, you can see I have a quote. The best way to teach your kids about taxes is by eating 30% of their ice cream, which I thought was very fitting because that's how it feels. It's like your gross income. You see, oh my God, I made this much money. And then this is how much I get. Oh my. But I thought that was a really simplified way of explaining our very complicated tax system. Okay, and the next thing we're going to look at is retirement. So with retirement, the biggest thing I can share with you is to start early. The earlier you start, the better off you're going to be. And it can be hard because you're young, you have all these other things you're worried about, but even setting aside a little bit early is going to help in the long run. So again, retirement is designed for long-term investment, and our government has actually incentivized this system to help people save for retirement. So they give tax breaks and so forth to help people do this. So a couple of ways, and probably the most common ways you can save for retirement is going to be in an IRA, which is an individual retirement account, or through an employer. So if you have a job, it's going to be a 401k more than likely. And that is the only type I'm going to talk about today, but know that there are some others, but 401k is by far the most common. So with a traditional IRA, the limit for this year is $6,000. They do allow, if you're over the age of 50, to put in an additional $1,000, so you can put in $7,000. They do change that amount so that it keeps up with inflation and so forth. So it's important to check it each year. But with a traditional IRA, let's say you don't have to do the full amount. So I'm going to say I can only save $3,000 into my traditional IRA. I'm going to put that $3,000 into it. And then when tax time comes around, I can deduct that from my taxes. With a Roth IRA, it's going to work differently. A Roth IRA is going to take after tax money. So you don't get it deducted on your tax return, but you get to put into the Roth, and it's going to grow and taxes have already been paid. So you're thinking, what is this? Why would you do that? Well, when you get to retirement and you have a traditional IRA and you take that money out, as you will, you'll take it out, it's going to get taxed at that point. And the idea is, well, when you're older, you're probably making less, so your tax bracket will be less and you won't owe as much. With a Roth IRA, there's not going to be any taxes because you already paid them. So when you take that money out, it's your money because the taxes haven't paid. So you can see the idea is to make sure this money gets taxed either before it goes in or after, but the government's getting their taxes essentially. With an employer-sponsored plan, it's going to work like a traditional IRA in the fact that it's tax deferred. So again, that money isn't getting taxed when it goes into the plan. Now with an employer or with a 401k, the limit I believe for this year is 19.5, and I think over 50 you could add another 7,000 if I'm remembering that number correctly. But know that again, if you're over 50, you get a benefit for that as well. With a 401k, the most important thing to remember is if your employer matches, you make sure you put in that amount. So your employer says, I will match 3% of what you put into your employee plan. So we'll just say that 3% is $500 a month. They will also put in $500 for you. That's just money they're giving you. So at a very minimum, if you can't afford anything else, please make sure you're putting in the minimum they match. Otherwise, that company you work for gets to keep that money. And of course, I wouldn't say they love it, but they don't mind it because that's money they don't have to pay to you. But that's free money you're giving up. So if nothing else, like I said, make sure you're getting that match they give you because it's money. It's just money they're giving you. I want to show you, this is from the Department of Labor, but I want to show you this neat chart that also tells you the power of starting early and what the power. So this is it's power of compounding essentially. This is looking at $1,000. And if you make 4% return on it, so if they pay you 4% interest over 10 years, you're going to make $1,481. So you made $481. So that's the worst this chart shows. But let's go down here. If you do $1,000 for 30 years at a 10% return, you get $17,449. So you can see how investing and keeping it in there for as long as possible, that small amount is going to grow so much bigger. So the sooner you start, the bigger that amount's going to be. And the less, I apologize, then the less you're going to have to make up for later, and you're not trying to make up for 30 years at the end. Again, I know this is hard, but if you can do just a little bit now when you're younger and grow it as your income grows, you can see how much that pays off. Even looking at just the 4% in the 30 years, it's still almost over double what you would have made. So you can see how important that is. Okay. And then the last area of the financial planning world is estate planning, or as the firm I worked for called it, the end of your plan, which I thought was a very eloquent way of putting that. With estate planning, again, I'm not an estate planning attorney, so I would advise you to go to one, but there are a couple of areas I wanted to point out. So should you decide you need to take care of your afterlife concerns, these are the areas that would be the biggest to pay attention to. First off, estate planning helps you avoid probate, which is a very, very convoluted, costly process through our court system, which I'm sure all of you want to avoid. It's already hard enough that you've lost a loved one, and then to have to go deal with a court, no thank you. So that's why you have estate planning. Then everyone who's been left behind can know that they can go through their grief knowing everything's taken care of. One of the most important parts of estate planning that needs to be set up is a guardianship. If you have any minor kids, please make sure you designate someone to take care of them so they go to where you want. I know, like, I don't have any kids. I have a dog and a cat. All my siblings have kids, but I'll tell you right now, they probably wouldn't want me to end up with the kids. They probably want one of my other siblings who has kids to end up with them. So it's really important to spell that out so the kids, your children end up where you want them to go. The next thing is power of attorney, which is going to be health and medical. I'm sorry, health and medical are the same. I meant finance and medical. Medical is going to allow you to designate someone to make those medical choices for you. So if you're really passionate, you do not want to be hooked up to machines, or you do not want to be resuscitated, make sure the person you designate knows those wishes and will abide by them. But essentially, they're making those medical decisions for you. Financial power attorneys going to do the same thing for the financial side. So you want to make sure it's someone you can trust, because unfortunately, there are people who would take advantage of those situations. So appointing someone who will take care of your finances and the way you want and know that they'll be handled the correct way is extremely important. The next thing is a will. A will is going to be a document that basically says your wishes. So where you want all your items to go would be in a will. And then you have a trust, which is more of a tax savings for estate saving. I'm sorry. Trust is a establishment set up to help save on estate taxes and takes things out of a person's estate. So it goes to the trust. The biggest thing with a trust and a will is that a will can be contested. So if somebody doesn't like whatever's in the will, they can contest that. A trust, no. A trust is not going to be able to be contested because it's a separate entity and items have been placed in there and have to flow the way the trust says. Okay, and that takes us to emotional finance. So we've covered the 6 areas. Hopefully, I've taught you something. There's so much in each one, it was hard to narrow it down. But I do want to spend some time on emotional finance because I think we all know money can cause emotions. I mean, you need it in everything. Whether you have money or you don't have money, both come with their own sets of problems, and both can be very hard. So the first thing I want to say is, one, it's okay to make money. Some people feel guilt or feel they don't deserve that money, and they shouldn't. It's okay. I mean, we look at all these billionaires who have more money than they'll ever use, and you look at what you have and you're like, oh my God, I have more than enough. And they feel bad about it, and they shouldn't. You've worked hard, you deserve that money. And it's okay. It's okay to feel good about that. The next item, never assume you know someone's financial situation. That has been working in the financial planning firm. That is something that I saw over and over again. People you assume had a lot of money did not, and people you assume did not have a lot of money were loaded and had plenty. So you really just don't assume anything. It's best to just not think, oh, they're loaded, they're fine. And they may not be. They may have a lot of debt hiding behind, the nice car and the nice clothes. We don't know. And we never should guess. I think it's best to just know that you don't know someone's financial situation. Talking about money is a good thing. I think a lot of people are scared to talk about it, and it's kind of a taboo subject, but it can be a good thing. Ask questions. If there's somebody you trust who looks like they've got their stuff together with their finances, ask them what they're doing or what they would suggest. It's good to talk about that, or talking about spending, it's okay. And I think it helps kind of connect and take that taboo-ness out of it, which may also help with the shame and guilt some people feel. On that same note, though, I think you should also decide your comfort level with sharing your financial life. Like I decided a long time ago, my husband and I said we'll never share what we actually make, like our income levels. We are going to share that, and we probably won't share a lot of numbers, but other than that, we're pretty comfortable talking about it. I live in the LA area now. One thing that people ask all the time is how much our rent is. People are fascinated with it because, I came from Kansas. It's quite a different atmosphere out here. I mean, our rent was more than twice what we were paying on our mortgage, and we are in about a third of the space. So, again, that's just what we decided our comfort level was. But with people asking about my rent, I felt comfortable saying, you know what, it's over $2,000, which is a lot, but out here it's not. The last thing I want to talk on is marriage and partnership. So if you're in a committed relationship with someone, make sure you discuss finances, whether you want to keep that. I apologize. There we go. Whether you want to keep your finances separate or together, it's really up to you. However, it needs to be discussed. If you decide to keep things separate and one person makes twice as much as the other, that's something you need to think about when dividing up bills and expenses, and make sure it's proportionate. That way you don't have the person making less being resentful of the person making more because it's not fair, and then they don't have any extra money to do anything with, and the other person seems to have plenty. So making sure you're talking about that and how you want to work through that. No right or wrong way. It's just whatever works best for you. All right. And now, like I said, we're going to spend some time on fraud. Unfortunately, where there's money, there's scams. I started at the bank back in 2009. And that, if some of you remember, was when the housing market crashed and times were tough. Well, our bank, and not just our bank, it was all banks, but they got hit like you wouldn't believe with scams. And no one had seen this. No one had seen these before. They were coming out of everywhere. And it was hard. It was a really hard time. But we learned a lot. And now I can say 10 years later, unfortunately, there are new scams and we're probably still learning a lot. But I want to walk you through a couple of my own personal experiences and then talk about a couple of other scams that are out there. So the first one, I will talk about a romance scam. These are some of the more difficult scams to see. We had one older lady who had reconnected with a gentleman on Facebook, and they had been in contact for about 2 years, and it kind of developed into a more intimate relationship. And so by the time we became aware of the situation at the bank, she had already sent about 20 grand to this gentleman. And we asked her questions, do you know them? And in this case, she was like, yeah, I've been talking to them for 2 years. And they just started asking for money, but we already had a relationship. And so you could see the pattern starting to evolve to where he wanted money to come visit, and then he needed money for a family emergency and so forth, until it got to about the $20,000 mark. And we were able to see what was going on. But when we asked her, like, do you know her? And she's like, well, yeah, I know him. And we realized, no, she didn't. Somebody had gone in and pretended to be this person and built a relationship for 2 years before they started trying to start the scam. So these people are putting in time, unfortunately. When you're like, oh, there's no way someone would do that. Unfortunately, yeah, there is. But like I said, the romance scams are just so hard because they do build that relationship and they really think they found someone out there for them. So it can be really hard to break it. And I know we had customers that would actually leave because we refused to help them send the money or get the cash. And so we just had to break the relationship off. Um, Fortunately, most of them come around, but there are cases where that doesn't happen. And I'm sure all of you right now have heard of the unemployment scams, which is where people they're trying to get your information so they can file unemployment. They know the systems are bombarded with unemployment claims, and they know that they can get a piece of this action because the systems don't know what to do. The people don't know what to do. California alone had, I think they said it was around 11 billion in unemployment scam, the cost of it, because so many people realized the system's not set up for this and they can get it. Some of you may have gotten the emails, the letters. My mom got a debit card from one of these places, hoping they could encourage her to call up, activate the card, and then they could get all her information. So they're getting pretty sophisticated with how they're going about this. But again, that unemployment scam right now, I think that's the biggest thing we're seeing. And that leads us into the IRS scam, which is tax refund, which is probably already starting, unfortunately. But the IRS scams, basically, they're going to either try to file a fake return for you and get that money, or they're going to say you owe back taxes and you need to send them money. So they're working on that fear and creating that urgency, like, oh my God, no one wants the IRS after me. Oh my goodness. And then they go about, oh, well, you need money for taxes, or you need money to pay this penalty. You need money to release this lien. I mean, they just go on and on with their reasons. And if they've created that panicky urgency, then the person's not thinking clearly, and they just think, I have to get out of this. The next thing is a money mule. We only saw this once or twice, but with a lot of these scams, they want to create layers of people so that it can't be traced back to anybody. And so we actually had, I want to say it was 2 customers in the whole time I was at the bank, but they actually received money from somebody else and they were instructed to send it on. And this is money laundering. It's illegal. You're not allowed to just send cash that you don't know where it came from and send it to somebody you don't know. Again, this is pretty rare because you can't really trust that somebody who gets money in the mail is going to send it on. But it does happen, and it's something you definitely want to stay away from. The Nigerian prince and the many variations on that scam, we've probably all heard of that. That's an oldie but a goodie, I guess. But you got your Nigerian prince who found a ton of money and they need to get it out of Nigeria. And boy, are they lucky they found you, nice American, who could help them. And then from there, they again need money for taxes or so forth. Social Security scams. This is another one I'll share a personal experience with. We had an older gentleman, and I think he was around 93, and he got a call from a U.S. Marshal saying his Social Security number had been compromised and he needed to send money. But the good news was the government would reimburse him for all of this because he'd be helping them catch some crooks. So this poor gentleman sent about $9,000 off. He was taking cash advances on his credit cards. He was told he'd probably end up with about 3 million when this is all said and done. So he's thinking, what's 9 grand? And of course they kept asking him for money. And luckily we were able to stop him at the 9 grand. But this case was really hard because the older gentleman felt so bad about that money he didn't have. He thought he could pay it back. He just said he hoped he could stay alive long enough to pay all these companies back because he didn't want them to have to go through what he went through and not get their money, which I just about, lost it because, he was just the nicest man. But you can see how that urgency, it just takes that logic out of your mind. And all you think about is panicking and thinking, oh my gosh, what if I don't do this? What's going to happen? Phishing scams, these also take a variety of, sorry, I lost my word, but it's going to be a variety of things. You can see phishing scams in a lot of ways. Some will try and say there's a problem with your account. Please call this number. I know I got some for like, oh, if you want to get your credit card rate lowered, call this number. And what they're hoping is you call them and then they can get all your information. So they can get your name, social security number, date of birth, password, address, everything they need to essentially take your identity. So it's really important. Don't give out any information that you don't want public, and then making sure you're actually talking to the right business. And then that leads us into identity theft. So from phishing, they're going to get all your information, and then they're probably going to use it to create identity theft, which is honestly a nightmare. But these people can open loans in your name, and they can do all kinds of stuff. If you give them bank account information, they can go in and transfer money out of your account. They can do all kinds of stuff. So it's really important to protect that information and make sure if you're talking to someone you do business with, that you have the right number. Again, never send cash to anyone you have not met in person. Don't send a check, cash, anything like that. That's one of your biggest red flags is never sending cash or gift cards, which are about the same as cash. They'll ask for those a lot as well because they know they can't be traced. Once that cash is gone, it's gone. Something that I didn't put in here, but I will quickly talk about is also you have the Craigslist scams where you sell an item and then they send you a check for more than the amount. So let's say I sell my car for $2,000, but I get a check for $5,000. They say, I'm so sorry, I accidentally messed up the amounts. Will you send that $3,000 back? Keep the $2,000, we're good. So I send the money back, and the next thing I know, the check's bad. And if that check's bad, it's pretty much like I deposited a piece of paper. There is no money there. So that $3,000 I just sent off came from me. There was nothing to back it up. The bank's not going to help me because why should they? I essentially deposited something worthless. So it's on me to come up with that money I sent off. So that's why it's so important to make sure you're looking and make sure that item makes sense. Like, why would someone send you a check for the wrong amount, especially that much over? So that's going to bring us to our red flags. So these are the things that we've found most helpful in helping people try and avoid a scam. So the first thing is, again, never give out personal information. You also always want to check the phone number on the check and make sure that it's who you want to call. Ask for another opinion also. Sometimes you're just so caught up in the moment and not panicking. That's when it's important to step back and say, wait, does this make sense? Ask somebody else. And if they're like, oh my God, no, that doesn't make any sense, then you know, okay, I can just forget about it. So these fraudsters aren't going to come after you. They're just hoping something sticks. Also ask your bank. As a bank employee, former bank employee, I can tell you, we do not mind being asked questions. We want to stop you from being a victim. We would rather get bombarded up front if it protects you. You can ask all the questions you want then come to us after the fact, because we don't want to see you lose your money either. We really want to stop it as well. Those fraudsters are just always a step ahead. And if we can stop them by informing people, the better. Also poor grammar. So if there are emails, you're like, who wrote this? Somebody who doesn't speak English? More than likely, yes, it probably was someone foreign. But the grammar is going to be bad. It's not going to make any sense. It's always good to, if you get that and you're like, oh my God, what do I do? Read through it again and then be like, wait a minute, would a company really mess up this grammar and have weird punctuation and spelling? No. So it's good to look at that, especially in email form. Weird contact information. Say you got a call from a bank that it says it's Discover card, but you're like, this is a 785 number. I know they're not in Kansas, so I'm not sure. Yeah, or if it's a block number. I know now they even have like spam risk, you can just avoid those. But it's important to look at that. And if you have any questions, go to the company's actual website, or look it up outside of where you're at. Go to a new site or go to a whole new computer and then look at that stuff and realize this isn't matching up. And then the next thing is check your credit report. So your credit report's going to give you a number based on how it's a score, and it's based on how good your credit is. 850 is the maximum number you can have. So really, I think they say anything over 750 is excellent. Anything over 650 is good. So if you know what that number is, that's a quick track, but most places tend to make you pay for it. So what you can do is you can get a free credit report every year from the 3 credit bureaus. And that will show you everything that's been opened up in your name. So then if you see anything odd on there, you can contest it and start the very hard process of getting your identity back. But if you can look at it and catch it quickly, that helps. So knowing that your credit report looks like and what's on it is a really helpful thing to try and stay ahead of that identity theft. All right. And I apologize if I missed questions. I don't know if anyone has any. There we go. But I didn't have my chat up, but it doesn't look like there's any right now. So it looks like we're almost close to time as well. But I wanted to provide some resources. And I'll quickly go through these. And then if any other questions come up, just let me know. But some of the resources, we have mint.com. So that's the budgeting online tool. It connects your accounts and it makes budgeting even simpler than a spreadsheet, because it just filters everything through and then it shows you your spending. I believe you can do several different types of graphs if you like graphs, but it's a really quick way and it takes the work of actually sitting down and writing out those numbers. So if you use a debit card or a credit card for all your spending, it's really easy to just connect it and it'll tell you exactly what you're doing. The next thing is investopedia.com. And my goodness, this is probably one of the best sites for teaching you any question you have about investing. One-stop site, and it has everything. I know I use this all the time when I was in school. It does a really great job of just explaining different investment topics and so forth. And then we have irs.gov, which of course is your one place for tax information, best place out there because of course IRS runs our tax system, but it's going to show you annual limits and you can read about deductions and credits and get everything that's changed for the year and so forth. The next one is Saving Matters. It's from the Department of Labor, so it's a government site, but it goes over retirement planning in detail. I went to the website to show you that graph that showed how compounding works. So it has a lot of good information out there. So if you have more in-depth questions about retirement, that's a great place to go. And then we have AmericanBar.org, which will help with estate planning. That is American Bar, so it's our legal system, but it has a great estate planning portion that really spells out definitions and kind of gives you a really good rundown of different things with estate planning. The next one is Money Diaries, which I actually, it's more of a fun site, but it looks at women's spending on a weekly basis. So someone tracks their spending for the week, and it also includes like what she makes in a year and all these other things. But I really like it because it helps you connect to somebody else and look at their spending. So you're like, oh my God, she spent $50 on a bottle of wine. And then it's like, well, I spent, $50 on pizza. Is it really that much different? And you kind of realize everyone's spending is kind of the same. Just look at it and talk about it. And then investor.gov is an investor fraud checklist. So not only is there fraud, like you can get scammed with a bad check or so forth, but there are bad investors out there as well, unfortunately. I know we've all heard of Bernie Madoff, and he's not the first nor the last Ponzi scheme, but he may be, the biggest. But it is important to look at that because some investors will take your money and not do good things with it. They'll either take it and make false statements for you, or they'll just poorly invest it and you're out. So it's important to kind of look at that and make sure you're with someone you trust. And then the last thing on here is the annual credit-report.com, which, like I said, you get a free credit report each year. And I think right now you can get a free one every week through April. But it's going to give you a free credit report. You can go to each of the 3 sites and get that report. And again, it lets you check all of that information. And I think that brings me to the end of my presentation. Let's see, I don't know. It doesn't look like we have anything in the chat, but if there's any questions or anything anyone would like. Otherwise, I think that's all I have for you today. So I really appreciate everyone that came in and joined us. But that's, I think that's all.